Good afternoon. Welcome to the podcast. My name's Chris Pollock, and today we have a very special guest. Today's guest isn't just a lecturer, he's a global voice in finance and a mentor to rising professionals, and someone who's been in the room where it happens. Osmond's worked in financial giants such as Lloyd's and the Bank of New York Mellon, and has achieved over 30 years experience in this industry, holds degrees from three UK universities, and he's known for kind of cutting through the hype of financial theory and delivering the truth. So we're really interested in diving into some of Osmond's thoughts. So welcome to the podcast, Mr. Osmond Plummer.
Well, thank you very much.
You're very welcome. So we want to kind of dive into what is probably the story of the year, Mr. Trump and his tariffs, or are they? What do you think Trump's, first of all, real intent with these tariffs is or was?
I think there's two sides to it. You've got one side is purely playing to his base. He wants to be seen as tough. He wants to be seen as putting America first, and it's the whole MAGA thing. And by sticking it to other countries, he's demonstrating how important and powerful. It's very much a domestic political thing. Mm-hmm. On the other hand, he does want to try and change the trade deficit America has with other countries, so tariffs is a very blunt instrument to do that. And there's a certain amount of bullying. He wants people to come crawling, and I mean, he's made comments about countries coming to kiss his backside. It's a bit of an ego thing as well. And he does genuinely, I think, with China, fear the manufacturing might of China and the control they have over such things as rare earths and this sort of thing. But tariffs isn't really an answer to that. That just ends up being an escalating war where one country puts, for instance, the EU was going to put a tax on bourbon, so he said that he'd put a tariff of 200% on French wine. So, who suffers in the end? The people who voted him in. So, it's a self-defeating exercise in my mind. Essentially, it's a bullying exercise on a lot of other countries in the world, and just to try and get them, they're not going to onshore more manufacturing, particularly in America. One estimate I saw suggested that if Apple made iPhones in America, they'd retail at £3,000.
Yeah, the consumer's just not going to have the appetite for that.
No, not at all.
Yeah. Well, I think because there was papers written by Donald decades ago about this tariff problem, right? So it's in his principles as wasn't a politician at the time, but as a businessman at the time, he was obviously conscious of these tariffs that were being charged to the US and saw that imbalance. It doesn't appear that he's getting tariffs released completely from the equation here. There are going to be just meeting with tariffs in the UK, for example, where 10% more or less across most goods. Do you think that's something that would ever go away under his presidency, or do you think he likes the idea of tariffs being on there in order to boost this potential manufacturing boom in the US?
He's described tariffs as the most beautiful word in the economic lexicon. I think he is serious about tariffs. I think he's using a sledgehammer to crack a nut to a large extent, putting these huge tariffs on to try and threaten people. What is happening is his 200 deals in 90 days became, I think, 2 and 1 pending. A lot of other countries are hitting back fairly hardball as well, and that's going to have an effect on US big companies. And then you've got the digital media taxes that are being proposed in the EU and the UK, and these sorts of things that he doesn't like. So there's quite a lot of kickback happening. However, I do think whether he's right or not is a different issue, but I think he genuinely believes in the power of tax.
So I think it's not necessarily just a negotiating tool. He believes that if he can get this in, this will be a political success and economic success for the US.
Yes, he believes it will increase manufacturing in the US. He also wishes to reduce the trade deficit the US has with other countries. And he wishes effectively just to put these other countries on notice that he's serious about all of it. But it's a very difficult thing to predict what's going to happen. They were on, they were off, then they're August, then what's going to happen next? And you've got this taco thing going around of Trump always chickens out. So we're going to have to wait and see what the end result is. I think the end result will be an increase in tariffs, but not 50%, not 100%. It'll be nearer the 10, something, resulting for most countries.
And he can sell that as a win for him.
Absolutely.
And then it's maybe not too detrimental, as the markets were obviously pricing in back in April with the initial kind of
the initial scattergun of Liberation Day, where they were proposing tariffs on islands that only host penguins and other things. That hit the market because no one thought it would be quite so severe. But also, then he withdrew it. Now, financial markets are almost ignoring the issue. As more announcements come, people say, the markets are saying, well, let's wait and see what actually happens, rather than jump and move the market with every announcement on Trump Social.
Yeah, there's just comments every day. Even Besant's been on the wires today saying that the date for China isn't necessarily that date in August. That can be flexible. So how long this escapade goes on for, I mean, it could be something that drags on not just more months, but potentially years.
It could drag on for a very, very long time. And it will, I think it will. If he continues to believe that tariffs is something that can solve all the problems. I mean, today's announcement that he's going to put a tariff on Russian goods if Putin doesn't play ball in Ukraine, you don't solve that problem with tariffs.
Well, he was trying to solve that problem this morning by asking Zelensky on a call whether, if he gave them weapons, could he strike Moscow and St. Petersburg. So maybe that's all part of the negotiation as well.
I think that possibly is, and again, is it a bluff? What is it? It would be an escalation that would be a risk. But again, Trump does like to make loud and excessive threats, try and squeeze concessions. So whether that is one of those things, by having it publicised that he's talking to Zelensky about giving him missiles that could hit Moscow or St. Petersburg, is that just another way of putting the pressure on Putin, who very much is not going to want the war to come home?
All right, so there's some big geopolitical issues with this as well as financial. Maybe we can bring it back to something you also specialise in with banking, especially in that initial window. It's not something I focus on too much regarding credit spreads and some of the kind of behaviours out of banks. What was going on in that small window, that kind of week or so when the world was on fire before the big U-turn or the first U-turn?
Things banks hate is uncertainty. And that is just, it has to be priced into the debt process. Wait a minute, if you are lending internationally and suddenly there are tariffs going on things, what's this going to do to the revenue streams to the people you're lending to? It creates huge uncertainty. And it means that a lot of the lending book will tend to dry up because of that uncertainty. Now we have higher rates than we've had for a while as well, which is making it more difficult to assess easily who to lend to. But certainly if you've got companies with extended supply chains through multiple countries, it makes banks much less happy to be committing assets in that way. And what you have seen also is this huge growth in private debt, which is unregulated until it all goes horribly wrong, and then will get regulated. But it'll take an explosion for that to happen, probably. But a lot of what banks used to do on the lending side has been taken up by private debt.
Okay.
And that is making, because banks are so regulated, and private debt at this point not particularly regulated at all.
Okay. I would assume private debt is probably provided by some fairly wealthy individuals. It's not the kind of taxpayer that will end up paying for this in the end. If we kind of rewind to my baptism of fire we were discussing earlier, that was the banks kind of overdoing it in a housing market that was not sustainable, and when it turned around, it wasn't the individuals that were just going bust, it was potentially the banks as well. With the private credit, could that have the same ramifications? Could you have a situation where taxpayers are having to step in to bail out the wealthy once again?
It's an extremely interesting question. On the face of it, you would say no. Private debt is private debt. It's up to the people who lend the money, who put the money up, and if they lose it, they lose it. However, if you think about the US commercial paper market in 2008-9, because in the great financial crisis, everything dried up. Banks wouldn't lend to each other more than maybe overnight. The Federal Reserve had to come in and act, and Bank of England did the same thing, as the lender of last resort and put liquidity into the market. And the Federal Reserve at that point had to the commercial paper market in the US, which is a huge corporate debt market in the United States, different to anywhere else in the world. The commercial paper market froze. So everyone said, if Lehman Brothers and Merrill Lynch can go under in a day, in a weekend, who's safe? And the shock to markets was Merrill Lynch, not Lehman Brothers. Because Merrill Lynch is as American as McDonald's. There's one everywhere. In every town, there's a Merrill Lynch rep. Their logo is the Bull of Wall Street.
Yeah.
They were the real shock. And so the Federal Reserve ended up coming into guaranteed money market funds, which were not supposed to be under the deposit guarantee schemes. And then it started buying up commercial paper just to keep the financial system going. Mm-hmm. Now, I don't think private debt is that big yet. But if it starts to wobble and fall over, it's going to have to be managed very carefully.
Okay. Excellent. Okay, excellent. Yeah, it's not something I know a lot about private credit, so yeah, I kind of assumed that it wouldn't land on us in the end, but perhaps there'll be a way that
it shouldn't land on us. But big money and politics tend to be linked. The financial crisis in 2008-9 technically shouldn't have landed on governments. The financial system was at risk of collapse, and they deemed it appropriate to bail out, for instance, AIG in America. Mm-hmm. They let some go, but they bailed out quite a large number of institutions, as did the UK with RBS and Lloyds, as did Switzerland with UBS. The Swiss government said UBS is a privately held company. If it goes, it goes. Then they realised that if UBS went, so did Switzerland. So they then changed the rules and said that the Swiss banks, which is basically UBS now, have to have 19% capital. Mm-hmm. Sort of 12.
So that should be a bit more of a margin. Slightly more.
Exactly.
Unless another.
And they're complaining about that now.
Yeah.
It would take a huge thing to take that out.
Yeah.
But it could happen.
Anything is possible.
As we found out.
So looking closer to home, the UK, we obviously had our tariff arrangement kind of nailed on pretty damn quickly, right? With the special relationship maybe is back. Do you feel like we're going to regret this? Do you think in the end we can undo this if Europe and other partners manage to get something slightly softer? Do you think that's even likely for the Eurozone?
I don't think the Eurozone will get something softer. Mm-hmm. I think it provides a level of certainty, which again is something that we want. We want to see. It's not an absolutely impossible tariff to deal with. And there is always, of course, and he's only got 4 years in the job. And then when you come to the other end, maybe we can negotiate, have that at a different level, that be reduced again. Mm-hmm. But there certainly has been this complete sort of shell shock in the move away from free markets that we had. That would say you had these remarkable global supply chains with tariffs and border things. With US manufacturing, a car will cross the border 4 or 5 times with Mexico before it's finished. How many times do you apply the tariff?
Yeah,
and all these sorts of questions that are really very difficult to tell, because everything's been used to the free trade agreements in North America and so forth.
Yeah,
and we've still got those within Europe, which is good.
Yeah,
but the trade with the United States is going to be complicated.
Mm-hmm. Is this kind of part of a more broader kind of deglobalization story? So we voted for Brexit here in the UK. That's obviously kind of put costs up. We look at Russia being annexed from the global community, putting oil prices up. There's little sanctions here and there constantly on Iran. Now this is more of a big kind of blanket increase in costs, effectively to the consumer. Ultimately, I'm sure they'll stomach it.
It's the consumer who will pay. It does look at the moment that globalization is in reverse. That companies are going to be very careful about where they outsource production, what countries, and tariffs are going to become a part of that equation. Reverse may be too strong a word. Certainly, it has reversed. It's not going to go back to the 1800s. We're still going to have international manufacturing. We're still going to have goods moving backwards and forwards. And even with Trump's tariffs, Tim Cook calls up from Apple and sweet talks him for a while and gets iPhones exempted. There are always potentially exemptions. But the era that we knew, I think, is over. Yes.
Okay. So then China's kind of the big story here as well. You mentioned them already. There's a lot going on here. There was all this, forget the name of the drug now. He was worried about fentanyl coming into the US. Obviously, again, this is maybe just part of a political negotiation as to why he's doing it. Do you think there'll be a reasonably quick resolution in China? It seems to be going incredibly slowly from the little I see of it.
Yeah, again, China's leadership does not want to be seen as weak. That's quite important. The party has to be seen as strong and standing up for things. So it will kick back to a large extent. However, Trump, underneath it all, wants to be liked by international leaders. So he's got an incentive to cut a deal. There was this brief escalation earlier this year where Trump put tariffs on, so China escalated, and then they had a meeting in Geneva, as a matter of fact, where they made agreements about that, and everybody climbed down a little bit. And I think you will see that happen. But Trump is very concerned about the trade deficit with China, and famously not particularly concerned about what they do about Taiwan at this stage.
Yeah, that was bubbling away a couple of years ago. There was rumours of the invasion, wasn't there? A few exercises in the South China Sea.
There's been a number of exercises. I can't remember the actual year, but President Xi has given the army a date by which they should be ready to invade. But, of course, they're watching Ukraine very closely.
Yeah. Well, and speaking of these kind of smaller nations, I mean, Taiwan maybe not being the biggest trading partner, but there's plenty going on. Were there any particularly niche places? I know Vietnam, for example, they were walloped with 98% tariffs. Were there any particularly strange countries? I know you mentioned the penguin.
Well, there were the islands that everybody lives on, which is, okay, fair enough, and places with which the US has pretty much zero trade, like the Falklands and so forth.
Yeah.
It was a fairly random exercise in tariffing. That was basically a parting shot, and each one's going to have to come around and be negotiated at its own merits.
Yeah.
Those who haven't got much of a trade deficit, the US hasn't got much of a trade deficit with, will get away with it quite quickly. Other countries may see much higher. But I don't think anywhere the 98% or even the 50% is going to stand.
Sure. So what impact do we think we could get from this? Then we've had rumours, even Jamie Dimon was on last week saying that, we haven't yet seen inflation, but it's in the post. We believe it could take a year to kind of work through. Is there any way you can see that inflation isn't a result of high costs?
How doesn't that work? If you've got tariffs on goods coming into the country, prices go up. It's got to give somewhere. There will be increased inflation. There will be increased, we've seen it a lot, there will be increased volatility in markets. Now that, in a trading context, is great and terrible at the same time in equal measure.
Yeah.
If you're on the right side of the trade, you can make a hell of a lot of money. If you're on the wrong side, it can go horribly wrong. And, you've sat through over the years, just talking to one of your colleagues before about Nick Leeson in Singapore with Barings Bank. It was probably the mother of all whoops positions, taking out 20% of the Osaka Futures Exchange, and then there was an earthquake in Kobe next day. Took the bank with it. So, you've always got risk within these things. At the moment, as I said a little earlier, markets are really ignoring what's going on.
Yeah.
They were, the first time, it was huge dip in the markets, and then as this is, Trump is backing out, backing down, agreements are being talked about and so forth. The markets are actually effectively pretty much ignoring it. Now, what happens then is, so the markets are coping with uncertainty pretty well at this point. But as deals get struck, there are going to be consequences in various currency pairs and in various equity markets and so forth. And then also commodity markets are going to be increasingly volatile, I believe. That doesn't give them direction. It just gives them the volatility, which is trading opportunity, but also trading risk. It's not. I don't think it's going to be one of those things where you can say, "Great, this has been unidirectional for the last 6 months." You know, follow a trend.
Yeah.
I don't think we're going to have stable trend in the foreseeable future.
Day trading is.
Day trading, why not? Yeah. Go back to the dot-com bubble.
And then looking, we mentioned inflation there. What about growth? So we obviously saw GDP figures come in for the US quarter, 0.2 revised down to minus 0.2 revised down to minus 0.5. And we're this month in July now, expecting the next quarter's numbers to come through soon. Could we be in a technical recession here in the US already in the first 6 months of Trump's presidency?
I think you very much certainly could be in a technical recession. As tariffs start to bite, as you see, if you look at the trans-Pacific shipping trends for the last 6 months compared to last year, the huge drop in just the physical number of boats crossing the ocean. You've got less. You're going to have less sales. You're going to have less stuff being bought and sold, and ultimately, an economy fundamentally survives. I always used to think, as of markets myself, that the most important number was consumer spending, and the second most important number was consumer confidence.
Yeah,
both of those are going to take a hit.
Well, the confidence has been hit somewhat. It's just not yet been reflected as clearly in the hard data. But
no, but even Donald Trump said you'll only have $2, not $6. When you start dropping the sales, the economy suffers.
Yeah. And what do you, so zooming out a little bit, let's assume tariffs kind of stick in the 20 to 30 zone for the big institutions here. What do you think this means with a 5 to 10 year view for the markets? We talked about volatility short term. What does this mean for it? I mean, indices are at all-time highs. You mentioned the market's broadly ignoring everything now. So S&P's all-time highs again today. NASDAQ, Nvidia's up there. You name it. There's a lot pushing and pushing and pushing. Is this, super cycle in equities we've seen for the last kind of 40 years? Is this coming to a head in a kind of deglobalization world, or is it just as you were, liquidity, keep chucking money in?
I think there'll be a certain amount of what I call the Looney Tune economy for a while, which is when you had the coyote running off cliff edges and sort of keeps running and staying in the sky, then looks down, then goes, oops. We could be there already, very close. The AI hype is dangerous. I'm not saying AI isn't extremely powerful, isn't extremely useful, but I think the one thing that people who are in these areas, the one question people fail to ask is what could possibly go wrong. And when everything is irredeemably positive and we're going to change the world and AI is going to do everything, including your jobs, people don't tend to design these systems initially thinking about what's going to go wrong. They think about how it's going to go right. Just look recently, crypto, the exchanges that were put in place without adequate security at the back end of it, and then Mt. Gox got taken apart.
Yeah,
because they didn't think about how it could go wrong.
Yeah.
So that is a story that happens a lot. And I think you could see that in AI and what is AI training itself on, and how reliable is the data it's training on, and what is it not getting because it's not paying for it. So there's a lot of potential for stuff to go. I mean, if you use AI, it's fun, it's interesting and everything else, but if you start putting it into financial markets without asking questions, you're building a huge amount of unknown risk. And it's the stuff you don't know that causes the problems.
That's it. It's not the punch you see coming that hits you, right?
Yeah.
And then I guess the big one as well for this year is bonds, right? Trump's whole mantra when he came in was trying to get the 10-year yield down. He did a pretty good fist of it for a month or two. Now it's starting to kind of level off and push it somewhat. There's a lot of debt that needs to be refinanced in the second half of this year. He hasn't maybe got it down to the levels he was hoping to get it down to. What does refinancing at these elevated levels compared to where we were, 2, 3, 4 years ago, and before that, what does that mean for treasuries, for governments, for everyone?
You're going to have higher yields. You're going to have a higher deficit. The overall cost of borrowing for pretty much everywhere is going to increase. Rates, I do not think, are going down anytime soon, because I think we are going to have inflationary pressures. And at this stage, certainly in the States, unless Trump fires the chairman of the Federal Reserve and puts someone compliant in, that it's too big a job to have somebody doing as they're told.
Yeah.
If you do not want politicians running the Federal Reserve. We saw that in the UK prior to the Blair government. The Chancellor is not the person who should be setting interest rates. We saw it in Turkey again and again with Erdogan, and he appointing people who did what he saved the central bank, and the disaster that caused to the economy. Mm-hmm. You do need clear-headed, independent Federal Reserve Board. And a clear-headed Federal Reserve is not going to lower rates.
No, despite the pressure.
Markets, uncertainty, 10-year, it's going to kick up.
So you think the higher for longer story is going to be even higher for even longer?
Even higher, even longer. I think higher for longer. I can't remember who it was who said that when I die, I want to come back as the bond market. But the bond market is extremely powerful. It created our shortest term Prime Minister.
Yeah.
And the bond market is a big stick for politicians. So it is its own saviour potentially. The politicians may have to, and the Federal Reserve will, but the politicians may have to backtrack a little bit on certain things, because the bond market, when it hits you, it hits hard.
And from my understanding, higher rates aren't always terrible news for banks. There's maybe more margins in there they can squeeze out.
Got a higher interest rate margin nearly always, potentially. And that's very important for the banks. When we had interest rates around 1%, interest rate margins were there, but they were nothing like you couldn't price in when your mortgages or whatever it is you're lending are being priced at 6, 7 or whatever. So that allows banks potentially to make more money. The downside is they've got to really, really focus on the risk management.
Yeah.
Because asset quality is potentially going to deteriorate.
But the regulations hopefully are certainly better than they were in 2008.
The regulations are, and as I said earlier, the private debt market's taken a lot of the dodgy, well, not dodgy, but the higher risk stuff out of the market. Whether a meltdown in that will result in governments getting involved, I'd like to hope it won't.
Yep.
We've played that game before, and it's better if we don't play it again.
And then from our perspective, we obviously deal with a lot of traders in here. For the next 10 years, which markets do you think, if you could have 10 years of trading ahead of you, you had a particular FX, commodities, bonds, indices game to play, where would you like to place yourself to think this is where the action's going to happen, this is where the volume's going to come, this is where I'm going to make my money?
I think I would be looking at the commodities markets. Mm-hmm. That's where they're going to be very sensitive to tariffs. It's a sort of a derivative almost on the tariff debate. Mm-hmm. They're also sensitive to politics, with China occasionally threatening to limiting the exports of rare earths and various other. Battery technology is going to evolve and will involve needing materials and so forth. And if it's going to be you need to be, if you're on trading on commodities, you need to be fairly scientifically aware. about what's going on in technology, because then you can place your bets on what might be coming next and around the corner, because it will happen quick. Will lithium remain the choice? I have a son-in-law who works in battery technology at Oxford University, and he thinks not. So, wait a minute, all this money going into lithium, should we perhaps be looking at something else?
Okay.
So, there's two ways of, you well know, of trading. Trading based on trend and Fibonacci sequences and so forth. But there's also trading based on underlying scientific developments. And if you can be afoot of what's going on in some of those areas, the commodity markets, I think, is where the fun's going to be. I'm very wary of anything that's trading on an AI basis now. Nvidia is a marvelous company, makes great chips and everything else, but is it really worth that?
Yeah, knocking on 60 price earnings at the moment, is it? So.
Yeah, I mean, is Tesla worth that? No. Was it ever? No. So I'd be wary. I'm wary of capital markets, equity markets at this point. I think they're overheating. But I think where you really are going to see volatility, again, opportunity, but informed, looking at it, pick your commodity and get up on what's going on with it.
Yeah. Don't
just trade it off the screen. And I think that's where you're going to see money in the next 5 years.
All right, Osmond, thank you. Thank you for that advice. There you go, guys. Commodity trading is the place to be, hopefully, for the next 10 years. I'm 20 years deep, so maybe I need to brush up on my technology.
Brush up on your rare earths and all the ones you can't pronounce.
Indeed, yeah. Nearly set up a business doing that, but I couldn't pronounce them, so it didn't seem like the right thing to do. Well, great. Thank you for that overview there. That's been fantastic. I think we have a few questions, hopefully, in the audience. Would anyone like to lead the way? Who'd like to raise their hand and kick us off with any questions? Yes, please.
What do you think about the alternative assets market?
It's a really interesting market, the alternative asset market. And it depends, again, to a large extent, which bit you're in. I think private equity has had its day to a certain extent in the valuations, to me, look pretty much too high. And they're trying to squeeze too much money out of those things. Where I think you have got, again, a lot more potential in the in the alternatives is the computer traded algorithms, especially if AI can be brought into good use in there. So I think they are a good area in which to look at. Otherwise, real estate, very dependent on interest rates. So the area that I'd look at on the alternatives more than anywhere would be the CTAs.
Great. Yes, please.
As we talked about Trump's and tariffs, I would like to ask that is Trump planning to come out of U.S. national debt, or is it just dominating the world? What is the main reason for him imposing so much tariff?
I think it's a negotiating tactic. It's a bit of a bullying tactic to other countries. He has this idea that manufacturing should be back in America. I mentioned earlier that's going to make an iPhone very expensive. So tariffs will come. Tariffs will be there. He's trying to get companies to do what he wants, but these companies are going to act in their own interest. And they're going to look to their own economic interest, and you may even find companies leaving the United States, which John Deere, for instance, has ceased manufacturing in the United States. And that's a very American brand. So Trump is not happy about that. But they're a free company, they can do what they choose to do.
Any other questions from the audience? Yes, please.
When you were younger, what got you into a lot of finance?
I'm sorry that the answer to this is, I will be honest. I needed a job. So I grew up in Guernsey. So when I finished university, I went back to Guernsey to spend the summer doing nothing. And I thought I need to do something. And I went to see somebody who was the son of the person who babysitted me as a baby. And he said, start work with me on Monday. So this was wealth management for Lloyd's. So I started. And then after about 5 years, I was thinking as to whether this is what I want to do when I grow up. And I got called down and they said, would you like to go to Hong Kong? And I thought, that could be a laugh. So I went to Hong Kong, stayed there 5.5 years, and then I was in Dubai for 4 years, and then Switzerland. It's nice to see the world when someone else pays for you. And I got qualified in the whole wealth management thing. But I sort of fell into it a bit by accident, to be honest. My first degree was mathematics. I didn't do a finance degree. But maths has uses.
Great question, great answer. Any other questions out there? All right, well, thank you very much for your input. Yeah, it's been lovely to have you on,
Pleasure to be
Osmond. Here. Would there be any way you'd like people to be able to reach out to you on LinkedIn, follow your work?
Yeah, please do. If you make note of my name, you'll find me on LinkedIn. I'm fairly amenable to being talked to. So yeah, please send me an invite.
Wonderful. Well, thank you again, Osmond. Thank you
Pleasure.
for joining us, and yeah, we'll see you next time.